Hi, everyone. Welcome to our annual Tax Talk with Tana. We're here with Tana Keil today, a CPA we've worked with for many years, and we got a lot to talk about, so we'll dive right in. But we'll be sending out slides after the fact. We are recording this presentation, so feel free to distribute the video to friends, families, colleagues, anyone who you think it might be useful for.
And also, because we're recording it, we ask everybody to try to turn off your video and keep yourself muted the entire time. But yeah, we will definitely be sending out kind of a video link that you can share, as long as copies of the slides from some of the things that we're going to cover today. So we'll try to pull the slides up, but we may not have them up, for too long or the whole time, but we'll send copies of everything that we're kind of touching on today. So I guess we want to, welcome back Tana, and we enjoyed doing this the other year, and think it was.
Appreciate you having me again this year.
Yeah,
Absolutely.
so it was helpful to just kind of talk about. Last time we talked a little bit about collaborating with a CPA, the best way for clients to work with you and to get their information to you, make sure everything is clear. Today we're going to focus a little bit on things that are changing from, or what you can still do for the 2022 tax season, as well as some things that are changing for 2022, 2023, especially with the passage of the Secure Act 2.0. There's a lot more than we can cover in this webinar, but we're going to try to touch on most of the things that we think would affect our clients.
Right.
And if anybody has any, questions, feel free to put them in the chat. We'll be trying to watch that. We've got several questions that were submitted ahead of time. And if we can't fully answer the question today, we'll certainly follow up with you afterwards. So
Absolutely.
So I guess, let's
jump in.
Let's jump in and let's just go ahead and start talking about changes that occurred for 2022 and even for 2023. So Tana, one of the big ones, child tax credit.
Right. There was basically an additional $1,600 given to individuals under a certain age, and that has gone away for 2022. And there was not any stimulus given or pre-credits given, so we don't have to worry about that.
Right, that were paid along the way during the year.
Correct. So you won't have to be bombarded by those questions from your CPA about how much did you get, when did you get it.
It was nice to get it though.
It was, but then some people, when they filed their return, they kind of forgot that they got it, and so their refund was less or they owed. So it should just be straightforward for 2022.
And it's going back to 2000?
Yes, for under 17 years old.
Per child.
Yes.
Another one that was nice for 2020 and 2021 was that additional charitable deduction if you took the standard deduction.
Right. Unfortunately, that is gone away for us in 22 and future years, as far as we know. So you will only be able to take charitable contributions if you can itemize your deductions.
And for married filing joint, I believe the standard deduction is $25,900.
Yes.
For 2022.
Yes.
Andrew, you didn't even have to look at your cheat sheet for that.
Nope, I memorized all these numbers ahead of time. Tana, another one, the meal deduction.
Yes, you were able to deduct 100% of your meals expense for your business in 20 and 2020. In 21 and 22, but starting in 23, it will go back to 50%.
For those that are self-employed.
Yes, correct.
Filing a Schedule C.
Yes.
Yeah.
Let's see.
The gift tax exclusion, that's been increasing a little bit the last couple of years as well.
Right. It was 15,000 for the longest time. Then it went to 16,000 in 22, and now we're at 17,000 for 23. And that's per individual, per person.
So that's just the amount anybody can give to someone else without having to either pay tax from a gift standpoint or use your lifetime exclusion.
Right. Which you would have to file a gift tax return for. There were just there would not be a reporting requirement or any gift tax due
Right.
if you stay under that amount.
So I could give John 17, you 17, or my wife and I could give each of you 34, starting in 20.
Yes, you can.
I'll talk about that after we stop recording. Mileage, those that can deduct mileage. Now, a lot of what we talk about today may not apply to you if you're a W-2 worker, but
That's correct. Yes.
this again would be for self-employed. There's a standard mileage deduction given, and we were talking about it beforehand. What's changed there?
Right. For January through June, it was, I believe it was 58 and a half. Starting July 1st, it went to 62 and a half cents per mile. So when you gather your mileage for 22, you'll need to separate it for each of the 6 months so you can get an accurate representation of the mileage rates.
How do you, when it comes to mileage, how do you recommend clients keep track of that? We get that question. I mean, it's it can be daunting, but
Yes, it's highly auditable. What the IRS does require, if you are audited, that you have where you're starting from, where you're going to, who you're going to see, and why. So they want all of that in your mileage log. And I know there are certain apps that can keep track of that on your phone. A lot of people use those. That would be sufficient.
Or if you have a business calendar, just if you have an appointment
Sure.
on there, maybe jot that down.
Right. And just, those three things, starting, where you're going to, the client or individual you're meeting with, and why.
gotcha.
But mileage going from your home to your office doesn't count.
Correct. Yes, if your office is outside of your home, that commuting would not be considered a mileage deduction.
We've got new tax rates, new tax brackets. I think
Yes.
one of the benefits of inflation being so high is it bumped up the brackets and some of the other things we talked about more than in past years. I'm going to share my screen so we can look at 22 versus 23. So here's the 2022 marginal tax brackets, married filing joint versus single. And taking a step back, I think a lot of folks think I'm in the, for instance, 22% bracket. Oh no, I'm over that level. I'm going to pay 22% tax on all of my income. When in fact, it's a stair step graduated system. And your effective rate is really your true blended tax rate that you pay.
Yes. You just have to think of the tax bracket as your marginal rate. The next dollar you earn will be taxed at 22% or 24%, wherever you fall.
And these rates, I mean, the numbers that you're seeing here is your taxable income number. So if somebody made $200,000, say a couple, married filing joint made $200,000, well, if you contributed to your 401k and it's pre-tax, your W-2 already takes that off. So maybe your taxable income number is already $175,000. Then with the standard deduction, if nothing else, you would subtract another $25,900. And of course, there's other things, health savings account, potentially IRA deductions.
Yes.
But all of that works you down to your taxable income number. And then in this case, the first for married filing joint, $20,550. The first $20,550 is taxed at 10%. And then dollars between $20,550 to $83,550 are taxed at 12%, and so forth and so on.
And so this is 2022. Here is 2023. So as we plan for this year, you'll see this is the new marginal ranges for single and married filing joint. And there's a lot of things, as John was referencing, you can do throughout the year to try to get your taxable income lower. Retirement contributions, health savings accounts, other things we'd be happy to talk with you about. Also, we can distribute these slides. We sent these out as part of a beginning of the year, or really, I think it was end of last year,
last year.
the important numbers. But if you'd like another copy, we can distribute those as well.
But you can see, yeah, like for instance, the 22% bracket, well, the starting point $6,000 higher, but the ending point is, would it be about $12,000 higher? So in essence, you're getting $6,000 more falling at 22%. So you're being taxed a lower amount on more of your income is kind of the gist of it. But it's also important to note that your deductions come off the top of your income. So, you know, if you're right there on the border of say the 24 and the 32% bracket, that might be more incentive to do pre-tax retirement or try to
Right.
take deductions. And of course, we're in a pretty historically low tax bracket, you know, tax rate time. Doesn't feel like it. Everybody feels like they pay too much tax. I'm in that boat too. But yeah, you just think about where rates were 15, 20, 30 years
Right.
ago. They're surprising how those rates were a lot higher.
And it's important to note that none of the percentages changed for this year. So the top tax rate is still 37%, and no rate changed in between. So
Right, because there was legislation proposed of bumping those higher brackets and
Yes.
over certain income thresholds.
that's
And
right.
that
And
all
that did
got-
not happen.
That
That's
got
right.
kicked down the road.
And I'm sure a
So,
lot of people have noticed that their federal withholding probably changed in 23 to reflect that increase in tax bracket. So you want to pay attention to that if you need to increase it for any other reason.
Although it was a problem, what, in 21 or 22, the guidelines weren't enough and people were not getting the refund they were used to or they were owing tax.
Yes, and the change of the W-4, it made it pretty much impossible to fill out, and so people were not withholding enough through their paycheck.
yeah. So on this note, what kind of time do we have left for 2022 to lower our tax? What strategies can we take advantage of?
Well, up until April the 18th this year, you can make an IRA contribution. You can make a traditional or a Roth IRA contribution. For that same date, you can also make an HSA contribution up to your limit. And that's even if through your employer, they have taken some out through your paycheck, you can contribute on your own up to that limit.
Kind of top it off.
Right. So don't worry if you didn't have them maximize your HSA during the calendar year, you can do that up until April the 18th. If you are a Schedule C business, you could do a SEP contribution, and that is actually allowable up until you file your tax return. So if you extended your tax return, you would have until April 15th in order to make that contribution.
For
October the 15th.
October.
Yes.
Yes, if you extend, it'd be
Yes.
October the
If you
15th.
extended
Yeah.
April, you would have until October 15th.
Okay, technical question, Tana. If somebody files their return on March 15th, can they still do their IRA contribution up until April the 15th
Yes, they can.
if they reported it on their return that they
Yes,
filed?
they can.
Yeah, okay.
Yes.
And it just needs to be made, the actual dollars just need to be contributed by April 18th.
Yes.
This year's April 18th because the 15th is on Saturday.
And then there's a government
The
holiday.
Emancipation Day, yes,
emancipation.
that's correct.
The limit, so you know, $6,000 into an IRA or Roth for those under 50, 7,000 for those over 50, and those get bumped up for 2023 by $500 each. So for next year, it'll be $6,500 and $7,500. We've got the health savings account contribution limits. You have to have a high deductible health insurance plan in order to be able to contribute. So not everyone can. The better your insurance, the less likely you are to be able to do that. But it's a great savings vehicle.
And once you're on Medicare, you cannot contribute to an HSA.
That's correct, yes.
And if you swap mid-year, it's kind of prorated the year.
Yes, but you can use those HSA dollars if you're on Medicare, if you have a balanced HSA.
Right, right. Trust distributions.
Right, this is interesting because through a trust, the distributions to the beneficiaries, you can do that after the calendar year by making an election. And if you make that election, you would have 65 days after the calendar year to make a distribution for the prior calendar year.
So we're talking about March 15th.
February, the end of February, basically.
60, yeah.
Or March 5th.
March 5th.
Right.
That was a test.
You were boasting about not your memorizing of numbers
I
earlier.
memorized some of the numbers. Okay, so around March 5th for that.
Right. That's correct. And that is an election on the tax return.
The reason you would want to do that, but just kind of big picture of distributing from a trust and paying tax at your own income tax bracket and on your own return versus having the trust pay the tax.
Right. If you go back to those important numbers that Andrew just put up there a while ago, you can see the estates and trust tax rates, and it doesn't take much to get to that top tax rate of 37%. So it most often is better to go ahead and distribute to the beneficiary and have the beneficiary pay the tax at their graduated rate, which is much more desirable.
All right. Let's see. So we've talked about 22. Last thing. Let's say I'm waiting on a K1. I don't have all my documents prepared and ready to give to my CPA or to self-file. I'm getting close to April 18th. What do I need to do?
You can file an extension. The most important thing is to pay the tax that you owe by April 18th.
Do a projection, make your best estimate.
Yes. If there are different types of penalties the IRS has, the failure to file penalty is 5% per month of the tax that you owe. So you want to avoid that at all costs. And all that takes is just filing an extension.
And maybe overpay, because you can always credit the overpayment to the following year.
You can. Yes. A lot of people just go ahead and overpay and make their first estimate with their extension payment. So you can certainly do that.
But that's even if you've done, a lot of people make quarterly tax payments based
Yes.
upon a safe harbor calculation, meaning as long as you pay this amount, you won't be penalized. However, if you owe, say, $10,000 more and you extend, you still need to pay that $10,000. The safe harbor doesn't protect you from that.
That is correct.
Yeah.
Yes. The estimated penalty is a different penalty. They just, list the penalties. But the failure to pay penalty, if you do not pay by April 18th, is 0.5% per month.
Versus 5%.
Right.
Yeah.
No
And that
failure
would
to
be
file.
an additional penalty. Yes. And that's
Yeah.
an additional penalty on top of the 0.5%.
So the big penalty is if you don't pay your taxes by April 15th. If you forgot to file, there's a smaller penalty, but it's
Well,
not as
it's
punitive.
the opposite. If you don't
Oh, that's right.
file,
I'm
it's
sorry.
larger.
Yes.
If you don't pay, it's less.
That's right.
I feel better now. You got one wrong too.
It's harder than it looks being up here.
Okay, so either file by the 18th or file an extension,
Yes.
and then you have, I think this year until October 16th.
Yes. I think the 15th is on a Sunday.
Okay, let's jump into Secure Act 2.0. And this was a big piece of legislation, a lot of tax ramifications. We're going to cover some of what we think are the most applicable points for our clients. If you have any questions, let us know. So we may not get to everything that was in the Secure 2.0, but we're going to dive in and try to address the big topics.
It did just pass in December, so we're still getting guidance on the things that were passed as well.
Yeah, these are just some of the, here's what changed, but there may be kind of caveats to it or more logic behind it.
Right, and
Yeah.
some things that aren't set to happen like after 2023. Of course, there could be changes to those, as the tax law changes after this year. So
Yes.
I wouldn't consider those set in stone.
Right. So let's start with required minimum distributions, RMDs from retirement accounts, which already changed once with Secure Act 1.0, went from 70 and a half years old to 72. They're changing again. And they are pushing back the age at which you have to begin required distributions. So if you were born 1950 or before, well. not
You're already
all-
taking
and-
required
and you're not already
distributions.
right.
So you don't get to stop them.
That's
If
right.
you've already started them, you don't get to stop
That's
them.
correct.
That's right. So it's age 72 is the beginning date for required distributions. If you were born between 1951 and 1959, that's getting bumped to 73. And if you were born after 1960, it is getting bumped to 75. Now, who knows, by the time we're taking RMDs, if it'll be 85, they want their tax at the same time. Longevity and
Right.
average lifespan is increasing, so they're wanting to give flexibility. But
They want to make sure people have enough money, of course, to live out their years. And as that increases, then I think that RMD age will increase as well.
That's tricky because if people run out of money, they got to fall back on the government. So
it does present good planning opportunities. We towards year end, we talk a lot about Roth conversions. So you may have more years to convert money from your IRA to a Roth IRA before your required distributions begin. So that's one strategy that we may be recommending.
also, I just got to mention the qualified charitable distribution. If you are subject to required distributions and you give charitably, talk to us about this. It is a slam dunk and can be very beneficial on your tax return, especially if you're taking the standard deduction.
That's
Right.
right. It's a way to never pay tax on IRA dollars that you already got a tax deduction for on the front end. So it is a great way to give if you're so inclined. And you can begin doing those QCDs, qualified charitable deductions, at age 70 and a half. And then they can satisfy your required distributions at that beginning date.
Andrew, clarify, if you were born in 1960, what is your required distribution age?
1960 is 75.
Okay.
Yeah, so 1951 and 1960, I guess, is 73, 1960 and beyond, 75.
Perfect.
Great question. Lots of changes as it comes to the Roth component of retirement plans.
Yeah, so if you have like a Roth 401k, you no longer would be subject to required distributions. Although
That's right.
I guess most people would probably roll that to a Roth IRA, and
Right.
those haven't been subject to them anyway.
That's right.
So kind of just makes the playing ground a little bit more
Right,
level.
because the government's not getting their tax. They, doesn't matter to them.
Yeah. For folks that have SEP IRAs or simple IRAs, a Roth component really hasn't been available, but it's going to create the ability to open up a Roth SEP IRA. I know I've had a few clients that have wanted to get those dollars into a Roth, and we kind of had to do two steps where we put it into the SEP and then we converted it to the Roth. I mean, effectively it was, they got a deduction, then they had to pay the tax when they converted, so it kind of washed out, but that'll be nice. And the practicality of that is it may take a company like TD Ameritrade or Charles Schwab a little bit to get that implemented. I mean, all this just kind of came up in December, so everybody's got to get their technology and systems up to speed.
Right. I think it's going to increase the cost of their retirement plans with all the changes. So
Yeah.
just be aware of that.
And required distributions from Roth 401ks are eliminated.
You weren't paying attention.
Oh, we already talked about that?
We touched
I'm fielding questions. All right.
Another big thing is employer matches can potentially go to a Roth IRA or Roth portion of the retirement account. So
Right.
historically, employers' dollars have always gone pre-tax because the employer deducted it. So it had to go into the employee's pre-tax account, so they would pay tax eventually on those dollars. As I understand it right now, those dollars can go into the Roth portion. The employer is still going to get the deduction, but it's going to be added to taxable wages
That's
to the
correct.
employee.
Yes.
So
So the employee will pay tax on the employer contribution.
Right.
And then another little caveat, high wage earners, as it relates to the catch-up contribution, that's an extra amount that you can do above the normal limits. I'm drawing a blank right now, 55? No, 50.
50.
50. That's where you get to do a little bit more contributions to your retirement account. Those may have to go to the Roth component rather than putting it into a pre-tax.
Right.
So
Right. So you'd have to pay tax on those dollars before contributing.
this is another one I'm pretty excited about. The ability to potentially move unused $529 to a Roth IRA for the beneficiary of that 529. It's always kind of been a concern when we're helping clients plan for paying for college and education expenses. What if we overfund that? What's going to happen?
Right.
And so it's really nice to kind of know that you almost may intentionally want to overfund it, because that's a way to kind of get an extra Roth contribution.
Right. And there are a lot of limitations around this.
Yes.
And the IRS has kind of thought of, okay, well, the child is going to be out of school and then somebody's going to just start funding the 529 to roll it over to a Roth. Well, there's like a 5-year look back on that.
Right.
So they want to see what the balance was when it was not used as opposed to when it's able to convert it. And it has to be open for at least 15 years, the
Mhm.
529 plan.
And by that time, maybe they've changed their mind and don't let people. So this might be really beneficial
Right.
if your child's already graduated today and that money's in there. But if you
Yes.
open a 529 today, you got to wait 15 years before you can maybe
Right.
do it.
And the lifetime conversion limit is 35,000.
Right.
And it's still subject to that annual contribution
Yes,
limit.
it
So
is.
so if the contribution limit was 6,500, somebody put in 3,000, you may only be able to move 3,500
Right.
that year.
Right. You will be limited based on those IRA Roth limits.
Again, these are just kind of as we understand it right now. It'd be good to double check before you make any of these
Yes,
moves.
for sure.
I think also you can change the beneficiary of an account, and as I understand it, you can still take advantage of this. So if one of your children used up their 529, the other didn't, you can still, without triggering that 15-year rule, as I understand it, you can get it right. You can still change the beneficiary
Right.
on the
But
529.
the beneficiary of the Roth does have to be the same beneficiary of the 529.
Right, right. All right. What else we got in Secure Act 2.0?
Catch-up contributions. I mean, for a while there, they were pretty stagnant, but it sounds like they're going to actually be tied to inflation now, so that they'll automatically kind of increase
Right.
over the years.
That's good for us older folks.
Yeah, same with qualified charitable distributions that I was mentioning earlier. Those may be tied to inflation. This is something that will be very interesting. You can use a qualified charitable distribution to fund what's called a split interest entity. I think that's something like a charitable remainder trust or
Right.
unit trust.
It would not be for a fund.
Donor
advised fund. Yeah,
right.
you can't
Those
fund a
ones,
donor advised
right.
fund with a qualified
But
charitable.
a charitable remainder trust would qualify for that. And I
Yeah.
believe there's a $50,000 limit on that.
Gotcha. All right. What if someone makes a mistake and they didn't take their required distribution by year end? It's to date, it's been a 50% penalty. So if your
Yes.
R&D was 10,000, you didn't take it by December 31st, IRS wants 5,000 of penalty. They're changing that.
Makes no sense. Right.
It does not make any sense.
Right. It's going down to 25%. But you do have to get it corrected within 2 years.
There also mentioned something about like a correction window, and the penalty may even go down to 10% if you correct it within that correction window. Again, that's something I don't really know the definition of correction window yet, but
Right.
It'll
And
be
that may be
interesting.
within the 2 years, if you get it corrected.
okay.
Then it
Right.
goes down to 10%.
And then a statute of limitations.
Right. The statute of limitations used to start when you filed the 5329, which is how you report the excise tax. But now the statute of limitations can start with the filing of the return. And I believe that's 3 years.
Yeah.
Gotcha.
So as long as you file your return, then you would only have to do that for 3 years.
Gotcha. Solo 401k. So for self-employed folks, small businesses without employees, a solo 401k is a great retirement plan to set up. The contribution plans look at the same as a employer retirement plan, but to date, you've had to set it up by December 31 and contribute by then. They're now giving you more flexibility there.
Right. I think that's for the first year plans. Is that correct?
Right,
Right.
right. So you can do it up to when you file your return.
I believe so, yes.
And yeah, this next slide just kind of shows, you know, some other things related to Secure Act, and even that last bullet point, many other enhancements, credits, mischanges. There's a lot in this bill, and it's hard for us to cover it all in the 30 or 40
One
minute
thing I
period.
did want to point out, there is a provision for student loan payments to be considered elective deferrals for employees. So in other words, the employer would match based on the student loan payments of the employee.
So the employees paying down their student loan?
Right. Because a lot of times people are saying they can't save for retirement because they have all these student loans. So the IRS is now saying, okay, well, you can pay those student loans and that could be considered your deferral.
And
So
your
you can
employer?
get the matching contribution from your employer.
Interesting.
Yeah.
Yeah,
And
that makes sense.
That's for till 2024. So that could be one of those things.
Would that affect the student loan interest deduction?
No, because that would be something else.
Yeah, it'd be separate from that.
Right.
Surviving spouse beneficiary is a really interesting one. By not, so if your spouse passes away and you decide not to roll that money into your own IRA, you might potentially be able to take required distributions on their life rather than your own. It can reduce your required distribution. A little bit nuanced, but a big change from prior years. Okay, this we're going to move on to one that we get questions about. This is a little bit broader, but dealing with the IRS, and the IRS can be an intimidating organization, especially if anyone receives correspondence from them, or if they think they've received something from the IRS and it is not the IRS. So we wanted to just put some info in front of you on this.
Right. It's unfortunately dealing with the IRS is not a two-way street. They can impose things on you that you can't impose on them. They have been famous for sending out automatic notices, but then you can't get them on the phone to try to take care of it. If you mail something in, it takes them months to respond. So they have hired new agents. They are saying that this year is going to be a lot better, just for the fact that they don't have any COVID relief going on. There haven't been a lot of tax changes that they're having to deal with. So they think that this year is going to be better. So we'll see.
Will the IRS ever call me?
Will the IRS ever call you? They will send a letter. The IRS will send you a letter before they will do anything else.
Yeah, we've had clients in the past receive phone calls saying you owe past, you know, some back taxes, and unless you pay them right on the spot, we're going to send the police out to arrest you. That's all a scam.
Right.
I mean,
If anyone ever calls pretending to be the IRS, you don't talk to that person,
Right.
period.
Right.
You call your CPA, you call the local IRS office, you know, something other than talking to that person.
or at the very least, hang up and
Hang
then
up.
you dial the IRS.
Right,
Yeah.
exactly.
So they shouldn't proactively reach out. If there's any mention about buying gift cards,
No,
paying with Bitcoin, you know, these are all just kind of the latest scams that sick
Yes.
people are
Yeah.
trying to take
Hang out.
advantage of.
They will threaten that you're going to go to jail. I mean, it's horrible, but it's becoming more and more common. So
and they don't email either. So
right, the IRS.
yes, the IRS. They will send you a letter in the mail.
So what if you need to get a hold of the IRS? What's the best way to do so?
The best way, well, now, if you go to irs.gov, you can set up an account. You have more access to your own information than you have before. You can get your CPA to call on your behalf. We do have a separate line that we can call. That would cause you to have to give your CPA a power of attorney so they can talk to the IRS on your behalf. And we'll just have to see about the, the main 1040 number, if that response gets better for this tax season.
I mean, I've waited hours on that thing, only to realize that the automated prompt sent you to the wrong department.
Right.
Then you get transferred and get to start over.
And unfortunately, you don't always get a knowledgeable IRS agent either. So you could hang up with one agent, call back, and get a different answer with another agent.
Sounds like Social Security.
So it might be best, if you have a tricky situation, to let your CPA handle it.
Yeah. They have begun accepting e-files.
They have, yes, for 2022.
2022. Let's see. We are going to, and I'm looking in the chat on questions that come up.
Yeah, let's jump into some of the questions that were submitted ahead of time.
Yep. And then I'll get to those that I see in the chat.
Yeah. Let's see. One question that was submitted, Tana, was tax advantages of a 529 for a grandchild versus establishing a trust in the child's name.
Right. Well, as you can see from the tax rates, the trust does pay tax on income. The 529 plan allows the income to grow tax-free. So that would be the main benefit of that, to use the 529 plan.
I mean, neither one of them is going to get you a tax deduction for your contribution, especially in Tennessee, because we don't have a state income tax. They're not
That's correct.
federally deductible, but in some states, if you make a contribution to your 529, you might get a deduction on your state income tax. But yeah, you're essentially kind of earmarking those funds only for education.
Yes.
Whereas a trust could be any kind of expense for the minor, depending upon what type of trust we're talking about.
Right. And you wouldn't want to give control, of course, for other than education. So it just kind of depends on what your goal is with those funds.
We recommend UTMAs, sometimes Uniform Transfer to Minor Act, but custodial accounts for minors that kind of acts like a trust. It can be used for anything. It's got some tax preferential treatment on the first about 2,000 of income. So there's a lot of different vehicles when it comes to saving for college.
Yes.
Or Tana, and speaking of trust for minors, which we use UTMAs a lot. I mean, those are kind of a form of trust. There's a tax form for those UTMAs. Do those typically get filed on the parent's tax return, or does the child need to do a separate tax return?
Only if they exceed that unearned income amount. I think that Andrew just mentioned it's about $2,000 of unearned income. Then the child would need to file a return and possibly pay at the parent's rate.
So the parents can't really just add that to their own return.
They could do like a nominee. They could put the child's tax on their return, but usually it's better. I mean, they get a little bit of a break on the child's return.
Okay.
Yeah.
So it's usually worth it to do one for the child.
What if like a grandparent starts an UTMA? Would that need to, again, be separate return maybe for the child?
Yes.
Yeah.
Yes. Whoever's social security number it's in. Yes.
Okay.
And unearned income being dividends, interest, capital gains, capital gain distributions.
Other than W-2 or self-employment income.
Right.
That's right.
Right. Here's another question we got. If you had a hospitalization at the end of 2022 and you don't receive or start paying the bills until 23, which year's taxes would they apply to? And any tips on that?
Well, we're all cash basis taxpayers. So when we pay the bill, that's the year that we deduct the expense. We talked about like bunching deductions, so paying 2 years property tax in 1 year. It kind of works the same with medical. When you pay those medical bills, is when you can deduct it. Now, if you put the medical bill on a credit card, say in 22, but you don't actually pay the credit card bill till 23, you would deduct that the year that you paid with the credit card. So that would be 22.
Gotcha. This is a big one. How best to deal with assets you've inherited after the death of a loved one? And there's not one answer to this.
Right. It depends on what the asset is. A good way to think about it is if this would have been taxable to the deceased person, then it's going to be taxable to me. So if you've inherited a 401k or an IRA that was pre-tax, then when you take that out, you're going to pay tax on that. The main thing that's different is if you inherit property or securities, you do get a step up in the basis of that property. So that's a huge advantage to holding property in your name.
Property being real estate, property being stock.
Yes,
Yep.
correct.
So
Anything
outside of
that
a retirement
appreciates in
account.
value, right?
Yep.
So if I'm a beneficiary and the deceased had a house that they bought for 200,000 and it appreciated to $1 million, that 800 of gain is what gets stepped up at their death.
Correct.
And if I sold that house for $1 million the next day, I'm paying no capital
That
gains
is
tax on
correct.
it.
Yes. And
Um,
if they own a rental property and they've been depreciating that all of these years, taking that deduction, and then you inherit that rental property, then guess what? You get to start depreciating it at the fair market value.
Starts over.
That's right.
Well,
they changed the law before Secured 2.0. If you're not a spouse, you now have a 10-year window to take required distributions from retirement accounts. So that was a big change, that it used to be you could stretch them out over your lifetime. But I kind of come back to, this is a very personal situation. When this arises, please reach out to us and we can help you go through each asset and what are the tax consequences for each.
here's another one, Tana. Thoughts on the future of traditional and Roth IRA legislation? I mean, I don't know specifically what that question is getting at. I know a lot of there's been chatter in the past too about could the IRS change their mind on Roth being completely tax-free. But
I can't see that ever passing something like that. I think the Roths are here to stay. So I don't think I would give much into that. You know, our only hope is that, you know, things will keep indexing for inflation and that those Roth rules will stay around. I believe that they will.
I mean, there were even like rumors at one point about if your net worth or income was over a certain amount, maybe those people's Roths could be taxable, but there was all kinds of stuff. That,
Right. Yeah. You can speculate about
Oh,
a
yeah.
lot of things.
Well, that's good to hear. Okay, let's jump. There was a question in the chat for young kids in their 20s with very simple taxes. Is it better to e-file with the IRS or TurboTax?
We're trying to take money out of your pocket here.
Well, I mean, if you can file for free, hey, of course, do that. TurboTax, I think a lot of people enjoy it. They don't have an issue with it. I think if you just have a W-2, then there's no problem with that. I've used TurboTax for individuals, so I'm familiar with that. I'm not familiar with going on the IRS website and filing, but I would imagine that there would just be a quick matching process as far as the W-2 is concerned, and then you just pay your tax owed. Of course, you know, this would be standard deduction and no benefits, I guess, or no HSA or anything like that.
Right.
If you have a lot of moving parts, though, you can quickly miss a deduction that might pay for the cost of a CPA.
Right.
But, you know, that's personal too.
Yes.
Yeah. Let's see, Tana, this came from a client who's a realtor, but it's, you know, a question for all self-employed folks. If they don't have a lot of tax deductions, how can I keep from paying so much in taxes? I don't know, maybe some of that is like trying to defer income rather than get a actual deduction, but what are more common things you see there?
Self-employed individuals, they kind of get hard hit because they're paying, when you get your W-2, you're paying the Social Security and Medicare, you're only paying half of that. When you're self-employed, you pay the employee portion and the employer portion. So it's kind of a double whammy on that. But that's how you get your Social Security paid in and your Medicare paid in. So it can be an expensive tax burden when it comes down to paying your taxes. I would just say, look for every deduction you can. That mileage deduction for real estate agents in particular, that can be a huge asset for you, is the mileage deduction. Take advantage of your HSA and put away as much as you can for retirement.
Can't go wrong with an HSA
Right.
because it's kind of a retirement account too
It is.
after
Yes,
65.
that's correct.
Home office is one sometimes people miss.
Right. Home office, you can take that. There are two ways you can take that. You can take the actual expenses, which involves the actual depreciation of your house, which would come into play if you sell your house. That would be a different conversation. But there's a simplified employee home office that you can take, and it's $5 per square foot up to, I think the max deduction is $1,500. And you can take that and still take all of your real estate taxes and mortgage interest on Schedule A, and no depreciation on your home.
But if you're not taking the simple and you have a home office, you can also prorate like utility bills, property
Yes,
tax
you can do all of that.
based on the square footage
Based
of
on
your
the
office
square
compared to the
footage.
home.
That's right. So if you have a large home office, then you're going to be better off just doing the traditional home office deduction.
Make the dining room your office. No, it has to. Yeah, you can't eat in there. It has to be only for business. Tana, if you have an office, but you also work from home, can you take the home office deduction even
You
if you have
can have two offices. You just have to be very careful that it is legitimate.
Yeah, dedicated space.
Yes.
What we probably don't have time to jump into it, but paying the self-employed and your own side of the taxes, if you were to structure yourself as a different type of entity, as a S corp, for instance, is there a way to reduce some of the self-employment tax by doing that? And is there a sweet spot for that?
There is. I've done a lot of these calculations. Of course, when you become a corporation and then an S corporation, there's a lot more administrative costs that you'll have to endure. And I've found that if you are a high wage earner, then you're going to end up bonusing out all of the wages in your S corporation as salary, because we have to deal with the Tennessee excise tax of 6.5%. And if you're an S corporation, you do have to take a wage because you are technically an employee.
Right.
So there is a sweet spot between how much do you take as an employee and how much do you just take out as a distribution or, dividend, so to speak.
Right.
And that would be a calculation. I do those every year for people that are in that range that are not necessarily high income earners, or that are about in the 150 range, somewhere around that Social Security limit. Then we kind of work the sweet spot on how much to take as salary and how much to take as a distribution.
Gotcha. We've got another question. Can I convert a 401k before tax into a Roth IRA at any time? Is there a limit? And what are the tax ramifications that have to be paid immediately?
Right. It's kind of just like you're converting your traditional IRA into Roth. You would pay all of the tax in the year that you would convert those dollars.
Now, your plan may have restrictions on
Your
moving money
plan,
out of the 401k if it's an active plan.
right. You would have to go by your plan document if it allows that or not.
There could be some ways around that too. I mean, because yes, if your plan doesn't offer a Roth 401k, there may not be there's nothing to convert it to. However, some plans, once you get over a certain age, may allow you to do a in-service distribution, roll it to an IRA, then you could convert it to a Roth on your own terms or in your own accounts.
I think that's what, often 55?
Yeah, sometimes. Yeah, I think
in-service age?
55 is what you see sometimes.
Yeah.
but yeah, going back to the tax brackets we discussed, whatever you convert from a pre-tax 401k or IRA to a Roth, you do 5,000 or 10. People ask me, is there a limit on what you can convert? Well, no, but there's kind of a, common sense. You want your, not common sense, but a tax sense.
Right, you
You
wanna
don't
work
wanna-
your tax brackets.
Yes.
Right,
Yeah.
you don't wanna convert, that's gonna cause you to pay an extra 12% or something like that.
Right. So if you're right there, if you've got $15,000 left in the 24% bracket, yeah, maybe you do the 15, but if you do more than that, all of a sudden those extra dollars are taxed at 32%. It can become punitive.
Right,
So,
You want to field that last one?
yeah, I mean, this is kind of similar. It's a great question. Roth IRAs have had taxes paid on them already. So, in the future, when you pull money out of a Roth, if you've met there's a couple criteria you have to meet, being over 59 and a half, the Roth had to be open for 5 years. That money comes to you tax free. But when my income is only Social Security and a pension and withdrawals from a 401k, wouldn't my income be lower after retirement? And does it not make sense to convert the Roth until I retire, but also before I start making withdrawals from my 401k? So this is something Andrew and I look for every year, especially with clients that have stopped working. Maybe they've started Social Security, maybe not, but also they're not subject to the required distributions, because that may be, we call them the gap years a lot, where your income has dropped, and it is the best time to be considering intentionally paying some tax. You may not have to pay tax that year. If your only income is Social Security, that Social Security may not be taxable at all to you.
Right.
right,
But you have to be careful, because the amount that your Social Security is taxable can be contingent upon all of your income in that calendar year. So if you start converting money from a pre-tax retirement account to a Roth, that could also affect how much of your Social Security gets included as taxable income. And you almost end up with a double tax situation on those dollars.
right, yeah. The taxing of Social Security is a whole issue in itself.
Yeah.
You're paying tax on your tax.
Right, exactly.
Well,
Yeah,
and some of the timing of conversion, it's an art, not a science, because you're trying to predict, am I going to pay a lower tax rate now or in retirement if I wait to take it out then? Well, what if the tax law changes and the brackets change in the meantime? As John said earlier, we're in historically low tax rates. So it might be attractive to use up the 10 or 12% brackets now. And who knows? I don't think you'll pay less than that in the future, but the rates could bump up.
Pay attention to your standard deduction as well, because I've had a few clients that, from a tax standpoint, they had negative income. Maybe their main income was Social Security, and maybe they had a little bit of dividend interest, something like that. But when they put their tax return together, maybe their taxable income before that standard deduction is like $10,000.
right,
Married filing joint, you get a $26,000 or more if you're over certain ages.
right.
What is that age?
65.
65, thanks. And so, yeah, you absolutely would want to be doing a IRA conversion, because you're going to get the money out of your IRA completely tax-free. And we would encourage you to not just withdraw it, but convert it, because then you've sheltered it in a tax-free account. So, great question.
Couple last questions that came through. One was about, we addressed single and married filing joint tax brackets. I'm going to throw up, there's a few others. This is for 2022. So you'll see here, single, head of household is different from single. I believe that was the question. Married filing joint, and then married filing separately. On that note, Tana, do you consider, when both spouses are working, does it make sense to file separately versus joint? What should people be thinking about in terms of paying the least amount of total tax?
What I've often seen is some of these credits that a married filing joint couple cannot take advantage of. If they do run it married filing separate, then maybe the lower income spouse can take advantage of some of these credits. So it's worth asking your CPA to run, say, hey, could you run and see if it would be better for us to file separate? If you've got two wage earners, you've got small children, I would definitely check that out.
Yeah.
It should be an easy calculation.
I mean, yeah, your tax software just allows you to kind of run a
It
hypothetical.
does.
Everything's the same except for that filing
It
status.
does, yes.
Medical expenses, can that sometimes be a reason why you want
Right.
to file
Now,
separate?
if you do file separate, then both of you either have to itemize or do the standard. One can't do one and the
Okay.
other. So if one had the medical expenses, then the other would have to itemize as well.
Gotcha. And then the last question I see is the best way to get in touch with you.
Well, interestingly enough, I'm in probably, I guess, week 3 of starting my own firm. I'm no longer with Blankenship. It's a very amicable separation. There are certain reasons I won't go into, but I have started my own firm. And Andrew and John have all that information, but I'll give you my email address. It is,
I'll put that.
are you going to put that
I
up?
got a slide. I'm going to put it up right now.
Okay, great. If you have any questions, you don't have to be a client of mine to ask these questions. I'm happy to answer these on behalf of AJ Advisors. So you can send me an email and shoot me your question. I'll be happy to answer it.
I mean, Tana's been great to work with. I'm kind of excited you're starting your own, to be frank.
It's very exciting, very exciting.
And yeah, I mean, Tana, if she's been preparing your return at Blankenship, she was the one directly overseeing it and
That's
reviewing
right,
it.
yes.
So it really doesn't change much.
Right. It's just if you were a client of mine at Blankenship, there'll just be a form for you to sign so I can get the information. Of course, you know that information is protected on both sides. So we would just need to get that release signed. But you can email me, ask me about that. And of course, you know, if you want to be a new client, then that's great too. So plenty of room for you guys too.
So you can still file my taxes for 2022.
Well, on extension.
We're going to send out to clients who are also clients of Tana some more information in an email. We've been waiting for her to start up her own deal and be ready for that. But it'll have her contact info. And if you have questions, of course, let us know or let Tana know.
Yes.
Yeah, any questions from anything that we've said? If you think of it later, email us. We'll follow up to get those answers for you. We just very much appreciate you joining us. We look forward to continue doing more webinars. Oh, did another.
One last question. Your address, your physical address.
Yes. I have secured office space in Mount Juliet. So I don't even think you guys have this, but they will be able to post it. It's 2093 North Mount Juliet Road, Suite 16.
Perfect.
So and that zip is 37122.
Great. Well, thank you all for joining us today. As I said, we've recorded all this. We'll be compiling it and providing a link to the video along with all of our other videos. John and I plan to continue to do these throughout the year, and we'll definitely want to have Tana back next year this time. But if you have any questions on this material, we can send you slides, we can send you the important numbers, anything else you'd like to see. We want to be a resource to you.
Thank you so much. Have a great night.
Thank you.